All right, so we're going to go ahead and get started here. Just good afternoon, everyone. Thank you for joining us on this webinar. We'll be talking about the fraud environment today, and we'll also give a couple of tidbits that you QuickBooks users can use to help limit fraud in your organization. So with that, we'll get started. First, we have a disclaimer. This is just legal advice that we were given to cover ourselves. So we just want to make sure that you're aware that this information is not going to be for complete preventative of fraud, and you really should seek accounting and legal advice. So today on the webinar, we have myself. I'm David Alvey. I'm a partner here at Mays & Associates, and I've been here for 10 years, and also Vikki Rodriguez, and she's been here for 18 years now. And we both specialize in special districts and nonprofit audit. So here's an overview of what we'll cover today. We want to go over the definition of fraud, what really is fraud, why is fraud prevention important, and the fraud environment, and how to spot a fraudster or liar. We're going to go over the aspects of the fraud triangle. We'll look at adequate internal control environment and what you can do to make sure you have good internal controls. We'll go over some common fraud schemes that we've seen and that we've heard about. We'll also give some QuickBooks users out there some tips and tricks they can use to limit fraud in their environment. And we'll do some closing comments. So what is fraud? So we define fraud as a wrongful or criminal deception intended to result in financial or personal gain. So the act must contain the following elements. It must be intentional, that is, it must have been perpetrated on purpose, not as an accident or by mistake. It must be misleading. So you must be misleading somebody. So that would be such as having somebody sign a check for company A and then you as a fraudster change it to company B, so you misled the person signing the check. And also the third aspect there is the fraud must result in some kind of personal gain. And we don't necessarily talk about monetary gain, but we talk about, or it's also monetary, but also it could be non-monetary. And non-monetary could be conversion, like using company assets for personal gain, like borrowing the company work truck to help move your sister over the weekend. But it also could be emotional. So maybe you're doing a fraud to cover up something to help somebody else, a former employee, a friend, that sort of thing, from keeping them from getting in trouble. In the fraud sector, I have a table here of the top 5 fraudulent areas, sectors, and the bottom is the percentage. So if you look at this table, you will see that about 16% of all frauds happen to banking and financial services company, and about 11% happen in the government and public administration. So Mays & Associates, we primarily do municipalities, so it's 1 in 10 frauds happen to a government or public agency. On average, the typical organization loses 5% of its total revenue due to fraud. So that's a pretty substantial number. And in these days of kind of tighter finances with governments, 5% represents a lot of our budget. The median loss is $145,000, and 22% of the cases studied in this 2014 Association of Certified Fraud Examiners report to the nations, 22% of the cases involve losses greater than $1 million. Median time to detect the fraud is 18 months. Later on, we'll be talking about a couple of organizations that we looked at that they took up to 2 years to find these frauds. 82% of fraudsters do not have a previous criminal background, so they're not necessarily the criminal type. And external audits only detect 3% of the frauds out there. And that's kind of a hard percentage to give as an auditor. A lot of the public perception is that a financial statement audit is to detect fraud, whereas we're really trying to make sure that the financial statements are materially correct. And if fraud is discovered, then we're obligated to let the organization know. So how much does fraud cost? It depends on who commits it. The average employee costs the organization around $64,000. Managers, if convicted of fraud, are around $85,000, and owners and executives are around $600,000. And other costs to frauds would be forensic audits and spending time with regulating agencies.
Yeah, and one of the things I want to point out is just recently we did have an organization that they did find fraudulent activity, and I mean the actual fraud itself amounted to over $1 million. So that was the amount that was actually stolen. But in addition to that, basically the other costs involved when there is fraudulent activity with forensic audits. More often than not, you want to determine if there have been other instances of fraud that have occurred or related with your insurance and what the attorneys want to see. They require a forensic audit so that you are able to file a claim for insurance. So they want to know, was this a one-time occurrence? Has it been done more times than this? Are there any other areas that might have been impacted by the fraudster, basically? And then the other cost that is associated is basically time. With this agency that I was just discussing, they've spent so much time dealing with auditors, with many different auditors over 2 to 3 months, auditors from the state, auditors from the granting agencies, dealing with multiple auditors all at one time. So you can kind of understand, you go through a financial statement audit and you're dealing with one set of auditors. In these cases, you're dealing with, multiple auditors all at the same time, asking for a lot more detail than what you're subjected to in a financial statement audit. So, and basically your hands are tied as far as having to spend all the time to get them the information that's needed and looking for all of the documents requested. So again, it's not just the actual amount that has been stolen, but it's also just the cost of the forensic audits, the cost of the attorneys, as well as just all of the time dealing with watchdog groups and the regulating agencies and all the other audits associated with it.
Perfect. And then some other costs, some non-financial costs of fraud are embarrassment of management, loss of trust in the organization, and loss of respect for management. And really, these really do hinder an organization. And we've come in after frauds have occurred and have seen just the morale drop and the requests from the public, because we are dealing mostly with these government agencies with public funds. The loss of trust is pretty horrific, and also having the good name of the agency dragged through the newspapers. No one ever wants to see that happen. And a lot of times these frauds are discussed years and years after they've happened and still remembered. So the fraud environment. When we talk about fraud, we really talk about 3 different types. We talk about corruption, so that would be misusing your position within the organization to influence in a business transaction in a way that violates your fiduciary duties to the entity, or getting money back. And we talk about asset misappropriation, so that would actually be theft of funds from the organization. And we talk about fraudulent financial statements reporting. So that would be showing the financial statements of the organization to make it look better or more healthy than it is, using the journal entry process. And I have a graphic to the right here. Not a lot of fraudsters just use about half of them use just asset misappropriation stealing, but a lot of times you'll find that there's a little bit of both or everything going on. You're maybe stealing money and then you're using fraudulent financial statements to cover up the fact that you're stealing money. So here's what's called the fraud tree, and this kind of gives an example of what kind of frauds are under each set. Okay. So corruption, asset misappropriation, financial statement fraud, and you can kind of see what's going on underneath there. And we're really going to be looking at skimming and fraudulent disbursements. Those are the ones that we see most common in our organizations. So how to spot a fraudster? So the general profile of somebody that's stealing from the organization. So usually it's an employee of 1 to 5 years, and that accounts for 45% of all cases. An employee 6 to 10 years with the organization is 23% of all cases, and if you're over 10 years with the organization, it's about 25% of all cases. Usually employees are between 35 and 45 years of age, but the highest average loss is over 56 years old. So those are more the executive frauds, like we said back, which average around $600,000 of loss to the organization. So continuing with the general profile, the fraudster usually or probably works in the accounting or operations or sales department. Within accounting, 35% of frauds are check tampering and 31% are billing or false invoices. Within operations, you're more likely to see corruption, whereas 38% of all frauds in operation department are corruption. And within sales, same thing, corruption is around 29% of all frauds. And the fraudster probably does not have a criminal background. 86% of all frauds surveyed in this study did not have any kind of criminal backgrounds, and only 5% of them had a previous conviction, and then the rest of it was just accused but not convicted. And this fraudster will probably rarely go on vacation. We've seen in the past, a lot of times when you're cooking the books, you have to be constantly manipulating the system and staying on top of it.
And basically, you know, looking at the general profile, obviously that's the majority of your employees. So it is very difficult to spot a fraudster. And I think that's the point that David's trying to make here, is that it's not usually somebody that is going to be obvious. A lot of times when we do hear about fraud at different organizations, most of the time what you hear from people is, I never would have thought. And so David's going to point out some of the behavioral red flags, you know, things to kind of look out for, just to be cognizant as you're working in your day-to-day activity, because again, it's not usually somebody that you're suspicious of from the very beginning.
And even from the auditor looking in, the couple of fraud cases that I've been involved with, I was actually very surprised it was the person that committed it. And yeah, so these are some of the key behavior red flags that you'll see with a fraudster: living beyond their means, so extravagant lifestyles, that sort of thing; financial difficulties, talking about money woes; close relationship with vendors, so this would be more in line of corruption, or if they're getting kickbacks; kind of a wheeler-dealer attitude; addiction problems. A gambling addiction is one that we just recently had. Refusal to take vacations, again, they need to be cooking the books all the time if they want to keep the fraud going. And control issues, unwilling to share duties, so the ones that kind of want to do everything, or the ones that schedule their vacation around payroll cycles and disbursements.
Yeah, and those last two items are key. You know, that's why auditors always ask if you do have a mandatory vacation policy, or if, there's cross-training that happens. And, we'll discuss later about, good control procedures that you can put into place related to these. But, basically we cringe every time we do hear the accounts payable or payroll clerk say, well, we do go on vacation, but we do plan our vacations around the check runs, because again, you're not having somebody else fill in their shoes, which is often the times that you are able to detect if there are irregularities in the process.
Okay, so the fraud triangle. So this is really the key to detecting fraud. And there's 3 points of this triangle. So you have a pressure or motive, you have a rationalization, and you have an opportunity. And the first bullet under each of these 3 pieces are more of a sinister type, and the next one is more of an honest type fraud, not that there is such a thing. So the first one, the pressure I have is I have a gambling problem. My rationalization is I have been underpaid for the amount I work. We're having furloughs now, and I'm doing a lot more work, and I haven't gotten a raise. So that's my rationalization. That helps me sleep at night. And the opportunity, well, no one reviews the bank statements, so I'm pretty sure I can do this and get away with it. And as an example that we'll have later on of a personal case of mine, this is kind of similar to the second one here. The spouse lost their job. That was the pressure. They'll pay back the money was rationalization, and then I can work around the internal controls, and that was the opportunity. So within this triangle, they have to have all 3 of these to have a fraud, and the only one that we can knock out as good managers looking at internal controls is the opportunity. If we can make it so they could not do it, that's a way to break this fraud triangle. And as auditors, a lot of times, sometimes when we do our internal control testing, I always try to tell the person I'm talking to, I'm not trying to get you in trouble. I'm trying to make sure that you can sit on the witness stand and say, I could not have done it even if I wanted to, because there's good internal controls in place.
And so as David mentioned, opportunity is key for when you are actually putting your procedures together or looking at your controls that are in place, because again, basically you want to fight against a fraud actually happening. So the best way to do that is to not provide the opportunity. The other 2 items with motivation and rationalization, those are more kind of keeping your ear to the ground, listening to people as they're talking, listening to the grumblings, knowing how morale is, because, obviously if there's lower morale or, especially when economic times are worse, then obviously the pay rates aren't increasing as much as when the economy is good. And also especially now with retirement expenses and medical expenses going so high, organizations are having to cut costs, and so employees are feeling it. And so what you want to do is just make sure that you listen to people, listen to the grumblings, and especially when people are talking about how unfair they're being treated, those are the kinds of things that people will rationalize that, well, yes, now I'm making my own retirement contribution, or now I'm paying part of my medical, so I deserve to take something else. And so those are just more of like listening to people and just kind of knowing what the environment is.
Right. A lot of times the pressure, it could possibly be imposed on the employee, like Vic was saying. If they're paying for their own retirement now or their own medical, that's less money that they have coming home. So that's a financial pressure that was imposed on them. And also with the fraud triangle, it's really hard because you might not know the pressure, you might not know the rationalization. So a lot of times fraudsters aren't willing to give up that information. They're not going to tell you they have a gambling problem. They're not going to tell you that they're disgruntled. So those are things that are really hard to detect. So I have a real-life fraud example that I want to talk about. Before I started at Mays & Associates, I worked at a privately owned bank, and the branch manager there had been with the organization for 20-plus years, and his name was Bill. Again, we'll change the names to keep it the innocent. But when I was there in 2004, right before the financial crisis hit, the bank was sold, and then I left to come work at Mace. But about 4 years ago, I ran into Bill, and I was asking him how things were going at the bank, and he said that since I left, the bank had been sold 3 more times, and every time the bank was sold, his job was at risk. The new company wanted to come in and bring in their own branch managers and change the system. So basically Bill was disgruntled, and he was complaining about this. Later on, after a fraud happened, and I talked to my friend who got me the job at the bank, I come to find out that Bill's wife was going through expensive cancer treatments. So now you have a pressure of the expensive cancer treatments. You have a disgruntled employee that can rationalize a fraud. And then as this case went through the newspaper and the courts, I found out that what he was doing was he was doctoring bank statements. So there was a lot of elderly, wealthy people at this bank that would have their money in one-year CDs, and they would just let the CDs roll over and roll over and roll over. And so what Bill was doing was stealing the money to pay for the cancer treatments for his wife, and then doctoring the bank statements that were going to the customers at the bank. And the way it was caught was one of the financial managers of one of these customers at the bank noticed the doctored bank statements. And in total, Bill stole from 15 clients to the tune of around $2 million, and currently last year was sentenced to 12 years in prison, plus restitution of $2.4 million. So that was kind of an interesting case just in my personal life to see this happen. And you know, I worked there for 2 years, so I had a relationship with this person, and it was, again, the person I least suspected, the nicest person, threw the greatest Christmas parties, but stole money.
Okay, well now we're going to talk about the internal control environment, and you know, talk about controls and discuss also just, you know, things that you can do in your organization. Oh, sorry, let me get to the correct slide here. Little technical difficulty. But as Dawn's trying to fix this, I'll keep going. We're going to talk about the internal control environment and some specific things, some specific fraud schemes that are out there and things that you can put in place at your organization. So with the internal control environment, it's important to have a solid internal control environment for a few reasons. Obviously, to prevent fraud, to be able to detect it, but also just in case to defend yourself against accusations. You know, I recently had a client that pretty much got dragged through the ringer as far as getting accused of fraudulent activity. But when it came down to it, you know, after many costs of actually us coming in to do many agreed upon procedures, doing specific audit work where they wanted to make sure that, okay, well, this is what we're being accused of, so we'd like you to come in and actually do a special audit to look at these things. And, you know, and we didn't find any illegal activity. But basically, at least if you do have a control environment that is adequate or solid, you can defend against those accusations much better than if you don't have controls in place. So again, it is very important to have a solid internal control environment. So the types of controls you have is preventative, detective, and corrective. Preventative being the most proactive, and basically those are controls that are in place to prevent error or fraud before the transaction has begun. So this would be basically, you know, reducing or eliminating the opportunities to commit the fraud. And so key being segregation of duties, having pre-approvals over a certain disbursement limit, you know, having limits over cal cards and making sure that employees are actually in compliance with those limits, having good hiring practices, you know, doing things like background checks, particularly in the finance area, and also having do credit checks for people that do work in accounting and finance as well. Now, understandably, this can be very costly to have segregation of duties, particularly if you're a smaller organization. So it's not always, you know, most prudent to actually hire additional personnel, or maybe there just isn't budget to do so. So that's where the detective controls come into place. And so this would be, you know, controls that are in place to identify errors and irregularities in a timely fashion. So this would be making sure that you do have proper review procedures in place, and looking at bank reconciliations, exception reports, at budget versus actual reports, things of that nature. And then the final control is corrective. So this is basically the error or the fraud has already occurred, and if it's an error, it might just be an error in a journal entry, and so there should be a control in place to to basically correct that journal entry and fix any miscoding. But if there is fraudulent activity that occurs, then there needs to also be a formal process for that, as far as, whether it's termination, criminal prosecution. Like we actually at the firm, when we discuss with our clients, if we suspect fraud, our policy is always to discuss our concern or our suspicion with somebody that is at least 2 levels above the person or the area that we are suspicious of. And that's basically our policy. So definitely in your organization, you should have a similar policy also of what do you do once fraud has been detected, or even if there is just a suspicion or concern. The 5 components of adequate internal control, the first being is segregation of duties. And first I'm just going to flip to the next slide and then come back to this one. But segregation of duties, basically you want to make sure that authorization is separate from record keeping, is separate from custody of asset. That is the best way basically to reduce the opportunity to commit fraud. What I always look at when I go to a client and I review their internal control structure is, in the area of disbursements, does someone have enough access and duties to be able to write a check without someone else knowing about it or being involved in the process? So basically, if you have somebody who's an authorized check signer who also has access to the accounts payable module and the checks, and who also maintains the bank statements and reconciliations, and there's limited or no review, that's definitely a bad thing. Looking at the payroll process, can someone set up an employee or change a pay rate and send a check without, again, somebody detecting it, and that would be somebody that has the ability to set up an employee or change pay rates, also has access to the payroll module and the payroll checks, and who also maintains the payroll register. And again, without there being a review process or a very limited review process of the payroll register. And with the receipt cycle, is there someone that's able to actually prepare an accounts receivable invoice, who also takes the payment and also has the ability to write the receivable off? Again, these are all things where you don't have a very good level of segregation of duties. And so for organizations that may only have 1 or 2 people in their finance department, that may be the case. And so, or you have limited staff, or, the skills or competency to be able to have a really good review process in place, then you need to make sure that there is some other procedure in place that will compensate for these conflicts. The second component of adequate internal control is proper authorization of transactions and activities. And so this is just making sure that you do have policies in place and that you're actually in compliance with the policies and with the approval limits, and making sure that all employees are following these policies. The third component is having adequate documents and records, making sure that you maintain proper audit trails for transactions. And basically for any transaction that's performed, you should have an audit trail from start to finish of the transaction and have proper sign-offs as far as who is preparing the transaction and who has reviewed the transaction. The fourth component is physical control over assets and records. This is, basically keeping things locked up that need to be secure, particularly in the area of receipts. Again, as auditors, we always come in and want to actually see, from the time that you actually collect your receipts to the time that you make your deposit, where are those receipts kept? We want to see that they're in a safe or in a locked box. Oftentimes we'll be told, well, we just put it in an inbox and then we'll deposit it the next day, or sometimes it's just a couple times a week, but it all just lays out on somebody's desk. Again, you want to decrease the opportunity of fraud, and so having everything out in the open just isn't an adequate internal control procedure. And the last component, number 5, is the independent checks on performance. Basically, you want to do spot checks of registers or surprise counts, of things like petty cash or the cash register, things like that. Okay. So now we're going to discuss some of the more common fraud schemes that we've either somewhat been involved in as far as clients or previous clients, or have read about. In billing, it's usually involving false invoices, people making personal purchases, and fake vendors. Skimming, it's interception of incoming payments, particularly if you have receipts that come in that aren't expected or maybe not budgeted. Those are usually the most susceptible to interception, because nobody's really everybody's kind of expecting those property tax payments or those sales tax payments. Those are pretty regular, but sometimes if you do get a donation or some sort of lease payment or things that aren't expected, then those are usually the ones that are more susceptible to being taken without it being detected. With expense reimbursements and credit card use, people using the credit card or getting reimbursed for purchase of personal items, or even organizations that have gas cards, and the gas cards are supposed to be used for the maintenance vehicles, but then people may use it for their own vehicles. That also is fraud. Other non-cash items could be, inventory or assets missing, whether they're borrowed or taken or borrowed and never returned. Again, those are all common fraud schemes. There's also check tampering. This is a big one, changing vendor names or payment amounts. So I had a few years back, I worked with a small special district that had a very small finance department and had an outside consultant that actually did their bank reconciliations. But over the course of a few years, basically the office assistant that kind of ran the day-to-day operations had she had a gambling problem, and it was found out that she wrote many checks to herself. But this was a place that actually did have some procedures in place as far as all of the checks technically required 2 signatures. However, she was a check signer and had access to the signature stamps. She also had access to the checks, but the check registers did go to the board, which we thought was a good control to have. But what was happening was that she would actually initially write the check to a legitimate vendor, somebody that they were used to seeing all the time. And so nobody really questioned it as they reviewed the check register. Well, before the checks actually got sent out, she ended up changing those to an account that was in her name. And so nobody caught these checks for a few years. And I believe it was about 3 years. And over the course, these weren't large checks. There were actually a multitude of many small checks, and again, to vendors that look very familiar, so really not causing any attention. And the bank reconciliations weren't really being reviewed in that much detail, and so there was no comparison of the check registers that were being provided to the board with the actual bank statements and the canceled checks to actually see that the names on the checks matched. So again, this is definitely, a very good scheme as far as, taking 3 years to be detected, and really was only detected when the person went out on medical leave. Another common fraud schemes for payroll is, producing ghost employees and unauthorized pay rates. I had a nonprofit that I worked with where the payroll person had actually set herself up twice in the payroll system with two very similar names. And so she was actually collecting two paychecks every pay period. And again, it wasn't caught for several months. Another scheme is to actually over-contribute to the retirement or deferred compensation accounts. Again, it may not be a personal gain right at this moment, but it's definitely still a personal gain many years down the road. So that's something that people really need to be vigilant about. Other non-cash fraud schemes would, again, we've talked about it, but the personal use of company vehicles or personal use of credit cards and such. And then David's going to talk about this very interesting article about the Treasure Island fraud.
Yeah, this happened about 5 years ago, and it's really interesting because it's a little bit of everything. This crew, the Hetch Hetchy Power Crew, was basically a high-powered electrical crew that was on call on Treasure Island just in case any kind of power outage happened from the Hetch Hetchy power plant in Yosemite. And this crew was unsupervised. The supervisor was in San Francisco and never went to Treasure Island. So they were bored, I guess, is maybe what happened there. But they set up their own company. So on City of San Francisco's time, they set up their own electrical company as a vendor within City of San Francisco, and they were doing work on their own, so going out and moonlighting during the week that they're supposed to be working for the City of San Francisco. And they were working for other government agencies. Actually, they worked on a couple of hospitals and a couple of, I think it might have been Mare Island, but they were billing the work to these other agencies, still getting paid from the City of San Francisco, and then furthermore, they were stealing inventory from the City of San Francisco and using it on those projects, and also ordering inventory for the City of San Francisco and then using it on their own personal company time. And then also, they were doing a false invoice fraud where they had a relationship with a vendor that they would buy things from, but the vendor was happy with it because the vendor was charging a 75% markup on the goods, and in turn the employees were getting a kickback. So they were using this vendor and getting kickbacks from there, and then also they were using false inventory or invoicing for personal purchases. The ringleader, as you would call him, Mr. Thomas here, he was getting paid $170,000 a year, and he completely remodeled his house in Martinez and started buying stuff for another house in Blackhawk, and would doctor invoices and have the City of San Francisco pay for them. And some of them it was like $4,000 for a barbecue grill, $5,000 for a fountain, and around $18,000 for pavers for his house in Blackhawk. All of this was billed to the City of San Francisco. And this fraud went on for 4 years before it was caught, and cost in the number of, or it's around $250,000 is what they think. So this is one instance of, unsupervised crew with a lot of power and time, and using a couple of corruption, false invoices, and purchasing or personal purchases.
Thank you, David. So now we're going to talk about some common QuickBooks fraud and what you can do. And actually, we don't really mean to pick on QuickBooks. This can actually happen with many different accounting systems. It's just that more often than not, we always get the question of, is QuickBooks an okay system to use? Or we've heard, that there aren't, good audit trails related to QuickBooks. And so, but again, these are all things that can happen with any system that's in place. But most of our QuickBooks clients that we have a relatively simple accounting structure, and so we're going to focus on the areas that I mentioned earlier, the disbursements, payroll, and cash receipts. With the disbursements and check processing fraud schemes, the most common, again, is the dummy vendors, whether they're completely fake or they sound similar to a legitimate vendor. We recently had an agency where the executive director set up a company that basically just had like one letter different to the actual company that they were normally paying. And so again, actually went through the approval process and was actually approved, went through normal process, and nobody noticed it. Just as an example, not specific to this one, but if you normally pay PG&E and you set up a company that's PG&A, well, the check signer or the person approving the disbursement probably isn't going to notice it. So those are things to be aware of. With check tampering, once the checks are actually signed and approved, people will go back and do what they call washing checks or altering the checks after they've been signed. The original might be to Bill Smith, and then they've altered it to Bill Smith and Associates, and then they create a dummy corporation called Bill Smith and Associates and open a bank account, and then they're able to deposit those checks. Check register altering, as I mentioned before, the one district that had the fraud years ago, basically changing the name on the check register to a fake vendor after the check had been signed. So how, things that you can do to detect these things is to run a vendor listing and look for similar names. Again, looking for the PG&E, PG&A, Bill Smith and Associates. In QuickBooks, it's very easy to just set up a vendor name, and oftentimes they'll look so similar that you just think that, okay, somebody just made an error when they were keying in. But, those are things definitely to look at. Also, you want to look for high volume usage on new vendors. And then be wary of vendors that use P.O. boxes rather than a physical address, because again, that's very easy to set up a company name, get a P.O. box, and set up a bank account. And so it's a lot harder to actually rent a place out to have the actual pretend business. Cross-check the address and phone numbers on the vendor listing against payroll records. If there's a company that actually has the same address as one of your employees, you may want to question that. Also look for dollar amounts written. So this would just not as much on the vendor listing, but rather on the check registers. Look for dollar amounts that are written for amounts just under the approval threshold. So if checks over 5,000 require 2 signatures, look for checks that are written for 4,999 or 4,900, 4,800, and such, because maybe somebody that is avoiding the approval process. And then another really good procedure to put into place to reduce their ability to tamper with checks is basically after the checks are signed, have the check signer mail them out, or at least have it not go back to anybody that can manipulate the check registers. Other ways to detect in the disbursements check processing is verify the vendor names and payment amounts against cleared checks. Do a very detailed bank statement review. This is something I definitely harp on all of my audit clients about, is basically bank reconciliations need to be done timely, and there needs to be a very detailed review. Look at the reconciling items that don't ever go away. And, make sure that whoever is reviewing it is also somebody that actually knows what they're looking and cares about it. Have monthly bank statements delivered to someone other than the check processor. And if possible, put your account on positive pay. That is actually an option for QuickBooks clients as well. And that's a really good control to have, because basically the banks won't cash a check unless the vendor name and the dollar amount actually matches the actual check register that's electronically submitted to them. And so if they do cash a check that has a different name, technically it's the bank's liability. But again, you need to do timely bank recs in order to catch those things as well. One other comment I want to make too, just with the disbursements check processing, is look at your accounts payable aging and review for any unexplained items. Sometimes we'll see with QuickBooks, somebody will kind of, if we have an adjustment to accounts payable, they may do a journal entry to do it, and the description will be audit adjustment 2006, and then it never gets reversed out. And so these are things that you want to be wary of. Every item on your accounts payable aging should be accounted for and have backup in place.
And I just want to give an example that the monthly bank statement is delivered to somebody outside of even accounting, somebody outside of accounting, where I have a very small water district where they only have 3 people in their finance department, and their board is very, very involved. So the treasurer on the board actually receives the monthly bank statement, reviews them in pretty detail, and then gives them to the accountant to do the bank rec. And I feel that second look would deter somebody from doing something with the bank statements, because what if that was found during the review from the treasurer or the board member? And it's just a way that a very small organization without any additional cost can increase the internal control environment.
Okay, thank you, David. So now we'll talk about the payroll fraud schemes. So one of the more prevalent ones is creation of ghost employees. So these are fake employees. As I mentioned earlier, there was the organization where the payroll person actually set herself up twice, very similar names, and basically was able to receive 2 paychecks per pay period. Also, the other fraud scheme is to use withholding to hide overpayment, basically, and this is somewhat difficult to detect too, unless you really look at the payroll register in detail. But basically, they'll where their net checks look similar from pay period to pay period, they actually end up getting a big tax refund at the end of the year, because basically what they were doing was just still overpaying themselves but withholding it so that the net check actually was the same as what they should be getting. And when reviewing payroll checks, again, usually people are looking at net, not at gross, but when you're doing the bank reconciliation, you really need to look at the gross amounts to catch these things. Good ways to detect these schemes is, review the audit trail report for amount edits to the prior paychecks. These are basically alterations made either in the system or to the checks after they get paid. Look for any payroll liability adjustments, and review changes in the number of checks processed. So this is something that you could spot check, basically just spot check from payroll period to payroll period. If the check numbers change and you know that there weren't any changes in the number of employees, then you know that there are additional checks being processed. Another good thing would be to spot checks the pay rates for the people that anybody that's actually processing payroll. You should go through the payroll registers and just spot check that the pay rates that they're actually being paid actually match what has been authorized or what has been approved. So in the cash receipt cycle, so some common fraud schemes, you have, particularly when you have unexpected payments, we kind of discussed this a little bit earlier, but the things that are budgeted for or are normal, either monthly or quarterly payments, those usually aren't the ones that you're going to be as concerned about being stolen. The ones you really have to look out for really are more the ones that are unexpected. Other things to watch out for too is, like, if you say you bill for service and the customer pays by check, and then the check ends up actually not clearing, and so you have a non-sufficient fund check. So look at your procedures over this. If the same person that's actually collecting the cash has the ability to also void or write off the account, then you have a control issue there, because basically you've sent the bill, customer has paid by check, they're sent a notice that they have to come back and pay in cash. They come in, pay in cash, and then the cashier is able to write off receivable and then basically keeps the cash. So that's a very common fraud scheme. Another one is cash receipts taken after the initial sale. So this is basically they've taken the cash from the customer and then subsequently they'll void the transaction. And so at the end of the day, the amounts, basically the ledger detail still reconciles with the cash that is being deposited, because basically there's amounts that have been voided, and so you want to look at the voids and returns, or if there are credits issued. And then there's, of course, the diverting cash without recording a receipt.
And actually, just on that really quick, a lot of times for the voids or the reimbursements, you'll see those later on in the day, right before the till is closed out. That's more common when they happen. So look at it there. And then for the unexpected payments, that's really the cashier's function where they can intercept that. So if they got some kind of reimbursement for like an attorney or a grant that wasn't expected, the cashier can put that check in the till, take out the equal amount of cash, and the till will equal the same amount in total, but now the cash is lower and the check is higher. So technically, that's a way that they could do that fraud.
So some ways to detect these things, make sure that there is a policy for giving customers receipts, separate the reconciliation of the register, perform surprise cash counts, and review details for voids and write-offs. Basically, with the surprise cash counts in particular, a lot of times, again, especially with like the unexpected cash receipts, that's going to be something that's going to be very difficult to detect. So at least by having surprise cash counts, you have the threat of somebody watching over your shoulder, and so those that are going to be more honest, it's going to take a lot more for them to actually commit fraud, and especially if they know that there is kind of Big Brother watching over them, they may think twice before actually committing the fraud. Another good policy to have, just as a good practice, is make it a policy to not allow your employees to cash personal checks. Oftentimes I'll see or I'll ask the question or find out that basically, if there's a lot of cash in the drawer and somebody needs cash today, rather than going to the bank to go get it, they basically write a personal check to the organization and then take the cash. That's, as a general practice, that's not a good practice to have, and there are a lot of different issues that you can have by doing that and allowing that. So some general overall tips. Again, I keep harping about this detailed and timely bank reconciliations, but this is really, really key for any organization, but in particular for smaller organizations where you can't really afford to segregate all your duties, because the bank reconciliations, if they're done correctly and they're reviewed in detail, it really can detect errors and irregularities in these functions or these cycles, basically the receipts, the disbursements, and payroll. And that's why it's really important also to do these timely. You need to find somebody who's competent to review the bank reconciliations, which again we understand is difficult when you have a smaller organization and only have 2 to 3 people in finance. And may have a general manager that may not have any sort of finance background or the time to do it. So it may involve hiring an outside consultant to do it, or finding a board member that's willing to do it, or potentially an outside volunteer. But again, I can't stress enough how important it is to do these detailed and timely bank reconciliations. And again, as we talked about, even like with performing surprise cash counts, it's really more of, the people that are kind of more on the verge, that are more just like the disgruntled employees that are getting to the point of being able to justify doing something, again, may think twice before actually committing the fraud if they have the threat of being caught. So again, just trying to eliminate or reduce that opportunity for the fraud to happen. As David mentioned earlier, make sure that the unopened bank statements go to someone other than the person doing the reconciliation. Perform surprise cash counts. Another good practice is to have customer complaints or issues handled by someone outside of the accounting function. So just as an example, if you have a water customer that comes in and complains because they feel they've made a payment on their account, but their account hasn't been adjusted, that complaint really should be to a higher level of management in case, the customer may actually be speaking the truth and maybe the payment was taken by someone else. So it's good practice to have a policy that any complaints or issues are handled by somebody in management. As far as cross training, we've talked about making sure not just for detecting fraud, but it's just always a good control to have somebody cross-trained in all of your key areas, because you never know if somebody's going to end up going out on medical leave, and all of a sudden somebody's going to have to jump in and do payroll. But again, with the cross-training and then either mandating vacation or have people rotate duties or cover duties a few times throughout the year, it's just a good practice to have, because oftentimes that's where things can be detected. I had one example with a transportation agency many, many, many years ago that basically there was a bus driver that had the same route had been with the organization for 20 plus years, and basically back then was an older system, but he was basically taking half of the fares that were collected throughout his bus route. And the only time that it was actually found was he actually did have to go on vacation. He was basically forced to use it or lose it. He went on vacation. Another bus driver came and took over his route, and all of a sudden the revenue increased in double. And so that's how they detected basically that this guy had been stealing for years. So again, even if you don't have mandatory vacation for payroll and disbursements, make sure you shift those duties to somebody else at least a few times throughout the year.
And that's just also a good rule of thumb just for business continuity, just to make sure that, like Vic said, if somebody goes out on medical leave, the organization will continue to survive and continue to succeed. Also, have a whistleblower policy is a really good tip. We want a real strong policy that protects the whistleblower. Make sure that they can stay anonymous and be protected. And then for the QuickBooks users, I believe it's after 2012 version has an audit trail function, and you have to turn that on. It's in the functions, but you want to look at the audit trail to look at changes in vendor information, so that would be names of vendors or addresses. You want to look at changes to payroll information, pay rates, that sort of thing, and then also look for write-offs of receivables and cash receipts.
And one thing to note on QuickBooks too, if you are using QuickBooks, it's not necessarily a bad thing that you're using QuickBooks. It's just that you do want to make sure that you do have all these controls in place. But the other thing is to make sure that you do frequent upgrades. In the situation where it was the district where the lady was writing checks to herself, basically they hadn't upgraded in many, many years, and kind of looking back at the fact, kind of considering it, it's like, did she know that there wasn't an audit trail in the earlier versions, and that's why she was very hesitant to actually upgrade. So again, it's always good to upgrade and make sure that you do have these audit trail functions turned on.
Okay. Okay, so just a couple of closing comments about how fraud is detected. Again, as an auditor, we think we can find it ourselves, but in reality, most of it is done by tip. That's why a really strong whistleblower policy is important. So in 2014, 42% of all frauds were discovered by tip, 16% was discovered by management review, 14% by internal audit, and 6% by accident. And account reconciliation only accounted for 6% also. So the external audit, how much did that really take? We kind of alluded to it earlier. So it was only, hold on a second, sorry, technical difficulties. It only accounted for 3% of the overall audit, and that's one of the things that us as auditors don't like to hear, but it's one of the things that we need to educate our clients and our boards and our city councils that it's really management's duty to look at internal controls and maintain an environment that would limit the risk of fraud. And the use of tip hotlines, like you said, 43% are discovered by tip, are very important. Again, where the whistleblower can be anonymous and can be protected is very important. And then also the tone at the top. We want to make sure that our management teams at these organizations have a good ethical background and they stress ethical business practices. And with that, we'd like to open up the call to any questions we might have. So if you're on the telephone, now you're unmuted if you'd like to speak out. We also have a link here, and Dawn put it in the conversation bar for our surveys. We'd like to hear your feedback on anything you'd like to have, either with this or anything different with this presentation or any other presentations you'd like to see in the future. And then some upcoming classes that we'll be doing. We'll be doing a couple on single audit on the 22nd and 29th of this month, and then we'll be looking at the information system reviews with Dawn on August 19th. And any of the classes that you see here, or any ones for this one, and then last month we did 2 on the new pension standards with GASB 68 and 71. You can find those on our website. If you go under Resources and Audit and Government, you'll find links to the YouTubes of these videos. And not hearing any questions, I'd like to say thank you for joining us today, and we're always available to answer any questions, or if you have any concerns, please do not hesitate to contact us.
Thanks, everyone.
Thank you.